January PPI numbers hit the wires this morning. Headline inflation printed at 2.9%, above the projected 2.6%. Core PPI surged to 3.6% versus expectations of 3.0%. The second that data flashed across terminals, gold and silver reacted instantly. Vertical move, no hesitation. Silver is currently trading at $92 Western spot. That Wednesday high we discussed on February 4th at 92, it just got cleared. That level was the tape reading objective for the week. If you've been paying attention, you already know I called 92 specifically on Wednesday before the halt occurred. Price was pressing toward it that very day. Then the halt triggered and price was slammed down to 85. Yesterday I walked through the 150 EMA confluence on the hourly chart and the swing failure pattern that ran the Tuesday 9 a.m. New York low before reversing aggressively higher. That was a bullish signature. We talk about these moves before they unfold, not after. Meanwhile, the usual course sellers and social media gurus show up 3 days later repeating the same analysis, pretending they nailed the call in real time. Timing exposes everything. You either recognize that difference or you don't. Comment OG if you were here when 92 was called before the halt. That tells me who's actually paying attention. Here's what tape reading teaches you over time. Nothing in these markets is random. Everything connects. The manipulation reveals itself on charts, in macro data, across multiple time frames once your eye is trained to see it. Go verify the homework. Pull up any time frame. Mark significant highs and lows. Watch how frequently price runs a major low, triggers stops, then rallies. Watch how often it breaks above a key high. Breakout traders pile in, and then it reverses sharply. That isn't opinion. That's behavioral pattern recognition. That's tape behavior. Markets are engineered to exploit emotional positioning ruthlessly. So the real question becomes, are you being played or are you reading the playbook? That separation defines dependence versus independence. Independence is the objective. Apex predator mentality. Top of the food chain. You don't rely on me, you don't rely on anyone. Once you internalize these tools, they apply everywhere. Silver, equities, crypto, futures. It doesn't matter. The mechanism is the same. The manipulation layer runs deeper than most participants realize. But as time passes, the broader structural picture begins to reveal itself. Data outside the charts begins speaking. Headlines begin speaking. Not the way they're packaged for you, but the way you interpret them once you understand the system. That's mastery. 8 to 12 months of focused, genuine study and discipline, and you'll outperform the majority of market participants out here. Now let's zoom in. We've taken out that Wednesday high, dropped to the hourly chart. That high is significant. You don't immediately assume continuation. You watch for structure. You need candle bodies closing firmly above that level. If we see sustained closes above it, then continuation becomes the higher probability path. If not, and it's only wicks above with rejection, that's simply liquidity being harvested. Next tape reading objective sits at 94. Now let's talk about real price discovery. Shanghai silver spot is trading at $104. Futures at 107. Western spot is at 92. That's a $12 premium. Yesterday it was 9, today it's 12. Physical buyers in the largest consumption market globally are paying $12 above Western paper pricing, while the gap widens during a rally. Go review China's precious metals data from February 27th. Shanghai premiums are holding firm. Western spot climbs, yet Eastern physical premiums expand simultaneously. When that divergence persists through price rallies, you're not observing temporary arbitrage. You're observing structural decoupling. Whatever suppression tactics exist in paper pricing aren't suppressing physical demand. Now let's address what happened during that Wednesday halt. In a 90-minute window, while retail traders were locked out, 159 million ounces of March silver contracts traded hands. Retail couldn't access the market, yet enormous volume transferred. Many longs who were previously positioned to stand for delivery suddenly chose to roll contracts forward during a period when the exchange was effectively dark. Some were incentivized to step aside. Here's the key detail. More than half of those Wednesday contracts did not roll forward. They closed out, they took cash, and exited. Under normal roll conditions, longs maintain exposure by shifting into the next delivery month. They stay in the game. That didn't happen here. Open interest is shrinking, not rotating. The gamblers aren't moving to a different table. They're leaving the casino entirely. That says something about confidence in the house. While paper positioning reshuffled behind the scenes, physical demand continued moving in plain sight. In Singapore, lines wrapped around the block at Bullion Star. Buyers standing in rain for physical silver and gold. They weren't chasing green candles. They were accumulating during volatility. Physical buyers interpret corrections differently than leveraged paper traders. There's a fundamental psychological difference between owning exposure on a screen and holding metal in hand. On February 27th alone, 11.5% of silver was drained from Shanghai vaults in a single day. Nearly 40,000 kilograms left SHF vaults. During that same trading halt in the West, COMEX vault data showed 1.3 million ounces withdrawn, 218,000 ounces from Brinks, 624,000 from HSBC, withdrawals from JP Morgan and MTB. Total registered silver on COMEX sits near 86 million ounces, with open interest exceeding 120,000 contracts. That places the coverage ratio around 0.60. In other words, registered silver covers only 60% of 1 month's delivery obligations. When vault outflows accelerate in both Eastern and Western markets during so-called manipulation events instead of slowing down, it suggests informed participants understand the structure. Now, layer in India. Approximately $385 billion in Indian equity fund capital has been approved for allocation into precious metals, with permitted exposure up to 35%. That's institutional capital receiving regulatory authorization to rotate into hard assets. Beginning April 1st, Indian regulators have instructed mutual funds to value physical metal holdings based on domestic exchange prices instead of LBMA benchmarks. That is a formal step away from Western price setting mechanisms. 33 days until implementation. As capital flows east, price discovery migrates with it. Today marks something historically significant. Silver is closing February in green, which makes 10 consecutive monthly green closes. 10 months, 10 positive closes. The last comparable streak occurred during the late 1970s run into 1980, when silver advanced from roughly $6 to $50 in about 18 months. When momentum sustains for that duration without a single red monthly close, that's structural strength. Combine that with widening physical premiums during rallies. Combine that with vault coverage ratios near 0.60. Combine that with institutional capital receiving regulatory green lights to allocate. Combine that with rising geopolitical tensions. These are not isolated variables. These are converging forces. Now add geopolitics. The U.S. State Department authorized the departure of non-emergency personnel and family members from Israel. Bomb shelters reopened across regions. Official language advised individuals to consider leaving while commercial flights remain available. That phrasing signals contingency planning for potential airspace disruption. Within 3 hours of escalating U.S.-Iran tensions, approximately $650 billion was added to precious metals market capitalization. Gold rose 1.33%, adding roughly $470 billion. Silver climbed 3.82%, adding approximately $190 billion. These moves represent monetary hedging against oil supply disruptions, shipping lane instability, currency debasement, and military escalation risk. Physical metal operates outside sanctioned systems, blockades, and frozen digital accounts. Now let's address the bearish case honestly. CME intervention during delivery pressure is possible and has precedent. Shanghai premiums could compress if seasonal industrial demand softens. Geopolitical tensions often de-escalate. Retail could pivot from accumulation to liquidation. A 250 million ounce ETF sell wave would pressure price sharply. Vault inventories could replenish faster than current withdrawal trends imply. Those are legitimate risks, but examine what is occurring now versus what would need to occur for the bearish thesis to unfold. 159 million ounces were cashed out during a 90-minute halt. Participants exited rather than rolled exposure. Shanghai premium widened to $12 during a rally, not narrowed. Physical lines in Singapore extended in poor weather conditions. Vault coverage sits at 0.60 with synchronized east-west outflows. India's regulatory shift is already decided, effective in 33 days. 10 consecutive monthly green closes are now recorded history. PPI confirmed inflation remains hotter than projections. Retail positioning remains historically low. Geopolitical advisories escalated to evacuation language. The structural alignment is visible. Bottom line, silver sits at 92 after clearing a manipulation high. Price suppression attempts failed to prevent structural continuation. Shanghai trades $12 above Western paper while demand accelerates. Vault coverage stands at 0.60. 10 consecutive green monthly closes have now been recorded. India decouples pricing benchmarks in 33 days. $650 billion entered precious metals as geopolitical risk escalated to evacuation advisories. 159 million ounces were cashed out during a halt, while participants exited rather than rolled. Retail ownership remains historically light. February 27th, data confirms Eastern premiums holding through Western rallies. The data speaks clearly for those willing to verify it. Those who do the work are already positioned. This is education in financial warfare dynamics, not investment advice. Validate every source. Make decisions based on structured logic, not emotion or hype.